Mark Meldrum recently confirmed on his YouTube channel that he did in fact go to 100% cash with his personal investments. This certainly looks like Mark is trying to time the market, which is something that many of us have always heard you should never try to do. So let's talk about it. I'm going to be breaking down all the points that Mark Meldrum made in his most recent video as to why he went to 100% cash, and then give you my thoughts on if what he said makes sense, and then why I do or don't agree with him. If you're enjoying this video or any of the other content on the channel, I'll ask that you go ahead and like this video and subscribe to the channel. Both of those things really help me out and I appreciate them. One of the main reasons Mark cited as to why he went to 100% cash in his portfolio is because of the huge explosion in prices or huge spike in REITs over the month of November here in 2020. He talks about how many of the positions he took throughout the third quarter of this year and into the fourth quarter of this year, he had certain price targets on, hoping to make somewhere between 40 to 50% on those positions over the next 2 to 3 years. And in the month of November this year, he hit his price targets on many of those REIT positions, some of them being like 50% increases to what he just purchased them at a few months prior. So he's looking at that going, hey, I bought these investments hoping to make X return over the course of 3 years and I just made it in 3 weeks. I just need to cash out now and quit while I'm ahead and take the profits. I think I'm a fan of that idea, but that's also a bit of a trader's mentality. So this brings up an interesting point about taking profits and investing. If you know anything about trading, you know that avoiding big losses and capturing small gains is the way to become profitable and consistent over periods of time. So from a trader's perspective, anytime you make a small profit, you're right away considering selling that position to lock in your gains. And especially if you hit the price targets that you had for a position, you should be almost automatically selling that position unless some new information has influenced your plan since you bought it, which now makes you believe that the price will get to a new higher level other than just seeing the price recently go up. But most of us aren't traders, we're investors and we're investing for longer periods of time. Mark would tell you on his channel and other videos that he's just invested mostly for his own retirement income right now and for future growth. But should someone in that scenario be selling a position just because they made a short-term gain? It's a tough one to answer. To exaggerate it, you know, if you made 10,000% in a month, sure, you should certainly be selling it and just locking it in. Of course, that's going to put that asset in some type of huge bubble that you don't want to be involved in anymore and you basically just won the lottery. But on the other hand, if you're investing hoping to earn like 8% a year in an index fund and it makes 10% or 12% in 1 year, should you be selling that? Probably not if that investment is something that is more of a long-term growth-oriented position for you. It depends more about your goals for that account. But most of us aren't traders, and I don't think Mark was a trader here. He just made the profit that he was hoping to, so he cashed out, and I think I might do the same in that scenario. One of the things that might be helpful to know about Mark Meldrum too for this conversation is that a lot of his portfolio has always been REITs. He always buys REITs. He uses them as a current income strategy, but he's also been transparent about his options trading strategy on the REITs that he holds. You could check out one of his videos about that because I might not get the details exactly right, but basically he buys these REITs that have had 8, 9, 10, 11% yields, and then he'll also sell options surrounding that position for income. So he'll sell out of the money calls and sell out of the money puts, far enough away from that position that he doesn't think the price would fluctuate to those and he would actually get called on his options. But he's been transparent about earning a 10% yield on the long position in the REIT, and then also another about 10% a year by getting about 1% per month in income from selling the options. So he's like earning a 20% income on this strategy that he's considered to be fairly stable for him. So it makes sense that someone with that type of successful strategy would make that a large portion of their portfolio, and Mark has. I think that just helps explain a little bit as to why when Mark talks about the real estate trade not being as lucrative anymore, which is one of his other main points, that he's not going to be using that trade, so all that money that was in REITs is going to go to cash for him. There are 2 reasons that he thinks the real estate trade is no longer going to be very profitable moving forward. He especially said it's not going to be the same in the next 10 years that they have been over the last 10 years. I'm not a real estate expert. I can't tell you if I agree or disagree with that, but he just cites that cap rates are extremely high now, meaning real estate property values, also meaning real estate property values are extremely low because of low tenancy, low occupancy. He said he thinks those things will come back, but not anytime soon. So without knowing a ton about REITs and the real estate market, I could certainly see how those prices are really beat up right now, and I wouldn't be wanting to hold them. He starts to talk about the global pandemic getting worse again and how cases, especially in the United States, are, if you look at it on a chart, just like skyrocketing. And this is going to pose some issues similarly to like it did in March. Now, he did say he doesn't think it's going to be a 30-40% stock market and the United States index crash again, but it certainly isn't going to be helpful. Makes a lot of points about the vaccines coming and also the fact that they might not be readily available for the next, I think he said 5, 6, 7 months. The distributors and local governments of those vaccines have confirmed that it's going to take a little while before they're readily available for most of the population. So there's not much debate there. And I think it makes sense for Mark to be cautious about the effect that continued cases can have on the market, especially in industries where it's been more painful in the past 6 months. Maybe you can include small caps in that too, considering the vaccine isn't going to be all that effective until, people are taking it. Then Mark made a good point that I hadn't really considered specifically before, which is that the virus has really catapulted a lot of businesses into the digital world. He said there was a trajectory towards digitalization that everyone was on, and the virus made it go like this. But with that, there are a lot of business models that literally can't exist in a digital world. They have to involve like entertainment, for example. You have to go watch a performance on a stage, happen on a stage. And so when those types of things can't happen as everything else becomes more and more digitalized, then those are going to suffer. And that in turn, hurts the rest of the economy, which is one of the reasons why he thinks he doesn't want to be invested in it right now. And that's fair. He's just taking a really short-term view there. So I probably wouldn't disagree with him. I just wouldn't make a portfolio change off, the entertainment industry not being profitable for the next, whatever you think it might be, 6, 12 months. I'd just rather keep my portfolio objectives intact. Then to the sharp stock market growth we've seen throughout the month of November in 2020, especially in the United States. Mark said he wanted to get out while he was on top. I just don't like this logic. There have been plenty of months in the past where the market has had huge gains, and then the following months have also had huge gains. Momentum is a real thing, especially in certain sectors of the economy. So to say that November was a great month, now I want to get out, seems short-sighted to me. He might be right in the short term, but again, I might go back to the question of objectives for an investment portfolio. And even though November went up, doesn't mean December couldn't or next year couldn't. While I probably agree that it won't, that's going to be iffy and it could go either way. I don't think anyone has a crystal ball for where the stock market's going to be, especially not just because of how the last month performed. Mark said when he does start to get in here in the relatively short future, he's going to be buying LEAPs, so long-dated options, probably using calls on the indexes in the United States, but not necessarily because he thinks that those indexes will be going up. He notes a really interesting discrepancy in the options markets right now, and I don't know how these usually line up in most of history, so I don't know if this is extremely abnormal or not. Mark seemed to believe that it was. Basically, you can buy a call right now at a 10% premium or increase above current market prices, and then finance the price of that call with proceeds from a sale of a put that are at a 20% decline from current market prices. So that's, of course, not a symmetric relationship. If the market was just baseline and took random deviations from that baseline, there'd be a far lower chance of it hitting a 20% decline than a 10% incline. So the risk reward for him seems to make sense to be financing by selling those way out of the money puts, buying some out of the money 1-year long-term calls. Another way to play this could be to use both 10% differences from current market price, so a call at 10% above current prices and a put at 10% below. But selling that put then would earn you much more of an income than buying that call would cost you by what Mark mentioned. So you could use it as a bit of an income play. The sector Mark said that he's avoiding more than anything else is energy. I don't think energy is a fair market, to be honest with you. There's so much manipulation in supply and demand. It's so political. There's literally war and conflict around oil that affects oil prices. I know there are experts out there in this sector, but I'm definitely not one, and I've almost never even tried to get any idea of what direction the energy indexes or oil prices are going to be heading in because it seems so controlled and non-economic to me. From the video, it seemed like Mark believed many of the big producers, maybe Saudi being the biggest, is going to continue to produce a huge amount of oil, which will keep prices artificially low, and the stocks are not going to be able to profit at that position. So he doesn't want to be owning anything in the energy sector. Fair enough. I wouldn't say that I think it's going to go one way or the other, so I don't hate that idea, I suppose. I was extremely surprised by a comment that Mark made at the end of his video, in which he said he was going to do like Seinfeld and get out at the top. This kind of goes back to what I was talking about earlier on, but it's just surprising to me how confident he's at least presenting himself as at knowing that this is the top of the market, given the fact that everything you've ever heard of academically is going to tell you that you can't pick where the top of the market's going to be. And statistically, it's a bad idea to get out just because the market hits a new all-time high. And the reason for that is we know that, at least in the United States, the indexes go up over time. If you look at the frequencies of these occurrences, it's about 60% of trading days are new all-time highs. So if the market hit a new all-time high and you went to cash, you'd be missing out on a lot of more all-time highs in the future since they climb over time. But just to say that we're at a new all-time high he wants to get out at the top, I think shows that he might be a little bit overconfident and suffering from a little bit of an overconfidence bias in saying that this is certainly the top of the market. He could be right. It just seems like he was a little bit too sure of it to me. I certainly wouldn't be selling just because the stock market hit a new all-time high, specifically because of what I mentioned to you earlier. 60% of the trading days are new to all-time high. So it's going to happen a lot and you need to be invested. Maybe the last point he made was about interest rates and inflation. And he pointed out a very accurate point I totally agree with, which is that if interest rates ever start to rise and become at least a little bit competitive, then there's going to be a lot more competition for people investing their money. Right now, bonds just yield so little that it is, relative to historical standards, less advantageous to invest in them. You're going to make less yield on your investment. So there's an argument to be made that a lot of people see that and just go, okay, well, I'm just going to put my money into stocks then, even if they are blue chip safer stocks, it's going into the stock market. But as interest rates get back to 3 and maybe 10 years down the road, 5% yield, a lot of investors will probably be seeing that and going, okay, I'm okay with that type of yield. I'm going to change my investment mix from more stock holdings to more bond holdings, and that's going to be money coming out of the market. There's going to be competition to get back into bonds. Mark didn't say if he necessarily thinks inflation and interest rates will rise here, but just noted that that could be a trend you'll see in the future. It seemed a little bit odd to me. I'm sure he's not arguing that we're going to get big interest rate increases like next month, which is, why he's avoiding the market right now. But I could potentially agree that 3 or 5 years down the line, we're going to see rates higher than they are now. I just don't know that that's a reason to go. Actually, I do know. That is not a reason to go to 100% cash in an investment portfolio today. Let me know what you guys think. If you had any other thoughts about the things that Mark pointed out, or if you had any comments about what I said relative to his comments. If he's right, I'm right, whatever, just let me know. We can hash it out in the comments below. I always like to talk to you guys. And as always, thanks for watching.